Well, hello there, Maverick Traders. This is Rob Reinhold. It is nice to be back after being gone for a couple weeks. Let's jump into what happened this week. In this session, we're going to be going over the news of the week. We're going to take a look at all of those sectors, score them from +3 to -3, focusing on making the right trades in the right sectors with our sector analysis. Before we jump into the week, let's talk about our summit. We've been getting lots of questions, lots of people signing up. We are always excited to do these in-person summits. It gives all of our traders a chance to go somewhere fun. We do these in New York, Chicago, and Vegas. So this year will be in Vegas, and it gives you an opportunity to meet other traders and get to know some people and hopefully go home with some trading friends. If you want any details, go to the website. We have a banner now in the members area. Click on that banner. All the information you need is there along with the registration link. All right, let's get into the week. The week started off very rocky. So if you remember last week on Friday, we were getting the threats of the tariffs against Canada and Mexico for 25%. And they were announced over the weekend. And on Sunday morning, the futures opened up down about 3 or 4%. The very low point was a 4% drop. Now that's a big drop for just a one-day move. It bottomed out on Sunday night and then recovered a little bit, but we still opened down about 2% on Monday. And then we started to get some buying coming into the market. And then on Tuesday, it was announced that there was going to be a 30-day halt on any tariffs based on some concessions that were made, but the Chinese tariffs did not get halted. So those went into effect an additional 10% on top of what happened back in 2018. And that actually really the market brushed off completely. So we had, again, a big gap down, 3 to 4% over the weekend. And then by Thursday, we had recovered all of that loss and then even a little bit more. We also got some earnings. We got Google that really disappointed on earnings, and then Amazon on Thursday night disappointed earnings. That still couldn't take this market down. This market was actually very strong when you take a look at the candles, which we will. It wasn't until Friday and we got some economic data that it really sunk the market. And let's talk about what that data was. We got the payrolls report that it was actually a decent report. And the market liked this report. Yes, the average hourly earnings were a little hot. That is inflationary. That's added to a few other things we've seen that were inflationary this week. But this consumer confidence really shook the market. What happened is the consumer confidence dropped by about 4 points, but in that report, consumers are very, very worried about inflation. So if you take a look at what we saw this week, we got a little bit higher average hourly earnings, which is inflationary on the jobs reports. We got a consumer sentiment number that says people are worried about inflation. If we go up here to the ISM manufacturing report, the report came out fairly decent, but look at those prices paid. 54.9 versus 52.5. That was a surprise in the market. We're seeing some inflationary things work their way back in. Surprisingly, the 10-year bond yield did not go screaming higher because I think there's this tug of war between the incoming tariffs that will come in and likely slow down economic activity, which is going to be more deflationary. And then we have some inflationary thing. The bond market was really back and forth this week, but really on Friday, once we saw that consumer sentiment number come out, the market sunk and we pretty much gave up all the gains for the week. So by the end of the week, the markets were basically flat. The Dow was down about 0.5%, the S&P down 0.25%, the Q is basically flat, the Russell down a little bit. But take a look at the big moves we have in oil and gold. One of the things that was proposed with the tariffs with Canada and Mexico was only a 10% tariff on oil and gas. Now that's actually a really huge amount, and people were a little bit worried about that. When those tariffs got delayed, we saw oil lose basically what it gained in anticipation of those tariffs. Gold had a great week, screaming up to some new all-time highs as people are running away from the dollar and going into some other assets. Checking in on the charts, I just want to really break this up into a couple pieces. because as you see here, we have hit the same level here since December 3rd or 4th. You've seen we've hit it 3 times here. 3 times, and we backed off it every time. Ultimately, we've gone nowhere for 2.5 months. And really specifically over the last couple of weeks, we've really been trading between 59.65 and about 6,100 on the S&P. But take a look at kind of the runs we're getting. We're getting this run here and then a big gap down. We got a big run here, big gap down. This is tough trading because based on where you're getting in and getting out, if you're trying to get short on these big gap downs and then you're getting long as we've reached highs, there's definitely going to be some whipsaw here. Definitely a market where you buy on weakness, sell on some strength, but ultimately we have not gone anywhere at all. We've just been kind of sitting in this holding pattern. We come over here to the NASDAQ and it's actually a little bit weaker. We're not even back up to highs. So the Qs we're seeing are a little bit weaker than everything else. But ultimately, take a look at where we are on both the S&P and the NASDAQ. We're slightly, we are within like 0.4% of the 20 and 50-day moving average that are just stacked up on top of each other. And they're going higher, but not at a very steep rate. This is not a clear bullish or bearish market. If I had to lean one way or the other, it's leaning slightly bullish. But this is a messy market, and here's a great thing about messy markets. Remember, cash is a position. You do not have to be fully allocated during these kind of markets. So that's where I think we should be, and that's where we've been for the last couple of weeks. I know last week Corey added on a couple of very mild bulls, a couple of very mild bears, and a sideways trade, and I'm probably going to be doing about the same thing this week. The heat map just shows you that there were some big movers in the big tech stocks, big moves in Apple, Google, Amazon, Tesla. So these really weighed on the market, but there's just a real bit of red and green across the board here. So not a clear message here either on the heat map. So what does that mean? Look, it just means that the market isn't clear right now. We are really looking for consistent trending markets, and that's just not what we have. Remember our saying at Maverick, trade the market in front of you, not the market you want it to be, not the market you think it should be, but the market that is in front of you. And the market that is in front of us doesn't look like anything technically, and it looks like a lot of chop. And that's what we're likely going to continue to see because over this weekend, we're going to get some more tariff news from the incoming administration. Oh, sorry, not incoming anymore. They're actually in the administration. But this week, China announced that they were going to be retaliating with their own tariffs against U.S. imports. And President Trump said, oh, you want to do some retaliatory tariffs? We're going to come at you even harder with tariffs. So we might get some news over the weekend of even greater tariffs on China. Now, that's a big deal for the U.S. because the U.S. imports a lot of Chinese goods, and that could be inflationary. So again, we're seeing those inflation numbers start to come back into the market. As I said, there's also this worry that these tariffs are going to cause economic slowdown, which is deflationary. So we've got inflation right in front of our face, but we've got these tariffs that really could do both. Again, they could either add to inflation, and if they do add to inflation, it's going to cause demand to fall, which is typically deflationary. That's why we're not really seeing a clear sign higher from the bond market. This week, we get some inflation numbers. We get the CPI on Thursday. You can see they're ticking up a little bit too. 0.3 on the forecast for the core and for the headline number. So again, ticking up just a bit. We also are going to hear from Chairman Powell on Wednesday and Thursday. This is where he is grilled before Congress. If you want to waste some of your life, watch this on C-SPAN, and you can see both parties politically posturing, asking some of the dumbest questions you've ever heard. So it's not going to be all that groundbreaking. And then we do have retail sales. So I'm going to give this market a +1. That's where we were last week. It's just, again, this is a barely bullish market, but it's just choppy. Expect choppiness. With this new administration, we're getting lots of stuff to digest, and the market is being whipsawed around. So let's jump into sectors. This is where we're going to get a more clear analysis of where things are going and what's actually moving under the surface. Looking at last week's performance, pretty much everything was plus or minus 0.5% except for a few things. Consumer was a terrible sector here, down almost 3%. And we had real estate up 1.3%. Everything else pretty much just hugged right in the middle. Financials continue to be great. Financials are really nice. We're going to take a look at healthcare too. I think that sector looks good. But everything was really just close to flat here. We go into the individual charts. Let's take a look at utilities. Utilities, as you can see, we're just right there. We're right at the moving averages. One is pointed up, one is pointed down. That's going to earn you a 0 almost every single time. Going into communication services, and you can see this sector broke out last week. This sector broke out of this December high, and you can see trading at new all-time highs. Yes, we got a nasty candle on Friday, but this is still a very, very strong sector, moving this one from a +2 to a +3. Over to real estate. Here we have real estate. I'm going to give it a +1. It's hanging out a little bit. It's clearly above the 20-day moving average, but you can see one line's going up, one line's going down. So I'm going to give this a +1 on real estate. Next up is healthcare. As you can see, healthcare had a great week. And healthcare really is high basing here. So nice high base pattern here after a very strong bounce off the bottom. Remember, healthcare was the weakest sector at the end of last year and into the first part of the year, having a nice little bounce off the bottom. So +2 on healthcare. Industrials, look at it. It's right there at the moving averages. One's going up, one's going down. That is a 0 in our book. So really no clear indication on industrials. Look at financials. Financials, along with comm services, broke out of the December high. Looks great. If you really want to take a look at some great trades in the financials, we've got the trading firms like a Schwab and a Robinhood are just looking great. The big banks are looking really nice as well. Visa, MasterCard. This sector actually did very, very well this week. So we're going to upgrade it from a +2 to a +3. We're coming over here to consumer discretionary. Yes, we had this nasty candle here on Friday, and we dropped down a little bit. But look, I don't like to be super literal when I'm doing my sector scores, because if I looked at this on Thursday, it would have been a 0 or a +1. And if I looked at it on Friday, it could be a -2. If it's like one candle, I really kind of want to just kind of blur my eyes and say, hey, this is kind of where it is. It's around the moving averages. The moving averages are basically flattened out, telling me that at this point, there is no signal here on trend from the consumer discretionary sector. Now, from the consumer staples sector, same thing. We're between the moving averages. One is going up, one is going down. Again, no indication here. As you can see, there's a lot of zeros popping up. We come here to technology. I'm going to give this one a -1. We're below that 50-day moving average, sitting on the 20. If you wanted to score this a 0, that would be fine as well. But take a look at tech. Tech has really underperformed a lot of the other sectors going all the way back to November. Just has not been strong. So tech, -1. We come here to materials. Same thing. It is smack on the moving averages. One's going up, one's going down. Another 0. Finishing it up with energy. Energy, -2. If you want to give a -1, again, we're just not all that far away from moving averages. One is going up, one is going down. -1, -2. Let's take a look at the movement for the last week. And you're going to see a couple things strengthened. Financials and comm services strengthened. And then really everything else just went to 0. This is where we sit. We sit with strong financials, strong comm services, and healthcare. These have been the strongest sectors of the past couple of weeks, and they performed quite nicely this last week, except for healthcare. It was down slightly. Everything else is in the middle with a 0. And remember, 0 doesn't mean, hey, we're not going anywhere sometimes. Sometimes it does. But sometimes it's just, hey, there's not a clear indication of where the trend is. There's still a lot of movement, but there's just no clear indication of trend. And the weakest sectors at the moment here are energy and technology. So let's go into our trade slots and see where we sit here. We had a few trades drop off, 3 trades drop off. We had a max loss here in comm services. We had a max gain here in healthcare. And we had a very nice butterfly come in, Caesars, on Friday. Not for a max gain, but close to a max gain. So 2 winners, 1 loss for the week. But you can see we're not that allocated. Once these 3 trades dropped off, we have 5 trades out of a possible 15 trading slots. The market is telling us that there's no reason to be fully allocated with capital at the moment. It's just very, very choppy here. We haven't gone anywhere in about 2.5 months. We're hitting up against this resistance. We're getting big gaps down. There's no reason to be fully allocated here. So we're just going to just stick with what we're doing. We're at a +1 from last week. We're going to stay at that +1. And we're just going to add a few trades here. So I'm looking just to add 4 trades to the mix. We've got comm services, which is really the strongest sector at the moment. I'm going to add a +2. Real estate gets a neutral. Financials gets a +1. And energy is going to get a mild bear. Again, there is no reason to put on a ton of trades to be fully allocated in this market. It is not giving you this signal. Not giving you really any signal, and there's a whole lot of chop. So let's jump into some of the possible trades. Let's go ahead and jump into some of those possible trades in some of these sectors. Let's start off with that trade in comm services. Lots of good things. We've been talking about how great Reddit is looking, and some of the other social media. Meta has made all new all-time highs this week. Here we have Roku. Now, Roku has earnings coming up. And whenever you have a stock with earnings, at least this is my rule, you want to make sure that you have the appropriate strategy on for an options trade. The chart looks fantastic here. I really like the fact that it's an ascending triangle pattern and forming here, resistance in the 85, 86 area. It looks like once this thing breaks through, I think 90 is a pretty easy call on this. But again, we have earnings coming out, and these earnings are coming out next Thursday. You have to be aware in the world of options trading, it really makes a tight spread an all or nothing trade. And what I mean by that is when earnings hit, this trade, nothing's really going to happen before earnings. Once earnings hits and the stock gaps, it's either going to go to max loss or max gain very quickly. So it's very highly unlikely that you're going to end up with something in the middle. It's just very likely you're going to end up with a max gain or a max loss. So when I'm making a trade in this situation, I want to make sure that it's weighted a little bit in risk reward in my favor, meaning that if I'm going to risk $1, I want to be able to make $1.50. So that means if it's max loss, I lose $1. If it's max gain, I make $1.50. But just want to make sure they are trades that have more reward than risk in the situation of potential gaps. So that's going to be this one, the February 21st, 85.90 bull call spread. Remember, those earnings are on Thursday on this. If you don't like this one with earnings, go ahead and look at something else. There's lots of great stuff in this sector. In the real estate, we're going to do a zero trade, a sideways trade. This is the stock CSGP CoStar. You can see it's been really just hanging out here between 70 all the way up to 82. We have to pick a midpoint for this. So 75. I like being slightly bearish on this one. Thinking it's going to come back down into these moving averages. Give it out 2 weeks, February 21st, 70, 75, 80 butterfly. I think this one has a high chance of landing in that window. Financials is another great sector. Very, very strong stocks in this sector. I wanted to find something that had some momentum. So there's a lot of stuff that have momentum in this sector, but it's run its course. Well, I shouldn't say it's run its course. We have no idea if it's a run its course, but they've been running for a long time. So I really wanted to find something that had just really started its run, and this is FUTU, F-U-T-U. And you can see that this stock has broken out nicely. We had some resistance here in the 100. We broke out of that Looks like it's racing its way up to probably about 110 is my target. Great thing about options is we don't have to go all that aggressive. And I've already decided I'm going to do a +1 trade. That means that I'm just looking for it to not go down. So for me, this trade is a 1 week 105, 102 bull call spread. And you're going to pay about 60% of this $3 spread, which is $1.80. So you get $1.80 of risk, $1.20 of upside, but it doesn't have to go anywhere. It just has to not go down over this next week. Again, that is a trade in financials and a +1. And let's finish it up with energy, which we had already determined we're going to do a slightly bearish trade on. This one is Diamondback, FANG. And you can see we had this big fall, big rally up, and we've turned back down. And we've just been making little bear rallies and little bases here. You can see we just broke down off of a base. There's probably going to be some support in here in the 152 to 157 area. That's fine. Remember, we're only doing a -1 trade, so we don't need it to go anywhere. We just need it to not bounce. So the -1 trade is going to be that February 21st, 157, 160. The stock is at 158. So again, we just need it to just hang out in this area. If it goes lower than that, that's great. It's a max gain. If it hangs out in this area, still pretty close to a max gain. If it rallies up, then you know what? We'll take the L on this one and we will move on. Let's go ahead and wrap this up here. I want to be very clear here. There's sometimes when the markets are clear. You know, we say, hey, well, this is a +2 market, this is a +3 market, or hey, this is a -2 market. This is not one of those times. And for all 52 weeks of the year, when we come on here and do the trading room, you're going to hear us probably about 35 to 40 of the weeks have a pretty clear call on where the market is going, because remember, we're just reacting to the market in front of us. We're reading the tea leaves and saying, this is what's going on. Sometimes you read the tea leaves and you say, wow, big gaps, runs, gaps, runs, gaps. You just kind of throw your hands up and say, hey, this is not a market that we can correctly identify as a smooth trending market. And when that's the case, we have to recognize it, we have to accept it, and then we just have to vary our trading to make sure that we're not leaning too far one way and taking too much risk. The markets are cyclical. At one point, they will make a move where it's clearly bullish or clearly bearish. That's going to be the time to add on more capital into your allocations. Until then, you're really just playing the waiting game, throwing some trades out, trying to make a little bit of money until the markets get a little bit better. One thing we do have to acknowledge in this new market, since the new administration is in, they have brought volatility into this. And we're going to see most of the major overhauls in the government happen within the next couple months here. I expect these next couple months to be rocky, and what I mean by rocky is where we get a 3-day move to the upside, everything looks great, and then all of a sudden we get some news that plummets us to the downside, and then we have 3 days running down, everything looks like it's falling off the table, and then the administration comes out and says, hey, you know what, we didn't really mean that, we're going to change our mind, and then the market rallies. I think you just need to get ready for that. That is the reality of it. Whether you like it or don't, I don't care. It doesn't matter. That's the reality of where we are. So keep that in mind. Pull back your allocations, pull back your capital in play, waiting for it to get a little bit smoother. Then we can make some better trades. Thanks for joining me. This is the Trader Room. Goodbye, everybody.